Hey everyone, welcome back to the Smash Property Podcast. This week's episode is one of the first for 2026. It's the January property market update. We're going to take a look at what is happening in 2026. Firstly, 2026 is not going to be a year where the property market crashes, but it is going to be a year where you can't just buy anything and it is going to double and triple in value like we have seen in the recent few years. So today we're going to kick off our first 2026 property market update. We'll cover what happened through the end of 2025, what's changing heading into 2026, and how investors are thinking a little bit differently this year. If you're new, my name is Nick V. I'm the founder and director of the Smash Property Investing Buyers Agency. And every month we bring a property market update packed with insights from what we're seeing on the ground. And this week, and this month, I should say, we're going to go through some areas that you can focus on with budgets under 600,000 and also budgets over 600,000. We're going to get to that a little bit later in the podcast. If you get some value out of the video, appreciate a thumbs up. Consider subscribing if you want to see more property content just like this without any of the bias or the BS that you see out there quite a lot. Now let's start with the big picture as always, right? It's always good to understand what's happening across the Australian property market in general, and understanding a bit more about these numbers. So nationally, if I look at the national property market for the entire year of 2025, it increased by 8.6% at the median level. Now, roughly, that means about $62,000 added to the property values at the median level. And I always like to put it in dollar terms because you can talk percentages all day long, but what does it actually mean? Which is significant, but also not as significant as I otherwise would have thought based on some of the properties that I'm buying and I'm seeing out there for myself and clients. Now, in December, the national property market moved by 0.7%, which is about $5,500 in the month of December alone. So there's some pretty strong headline numbers there without a doubt. But when we talk at the median level, or we talk averages, it does hide what's really happening, and I will get to that in just a second. We're also seeing a lot of uneven growth, and I'm going to go through the capital cities and how they've performed for the month in just a second. And there were some actual numbers that are surprising for me with some of the major capital cities that we'll see. And yeah, like I said, it's an interesting. It's going to be an interesting year where you've got to be so particular about what it is you're buying, where it is you're buying, and how it fits into your portfolio, right? Like you don't just want to go out and buy anything for the sake of it. It's got to make sense for you specifically. And I'll talk through how you can kind of make sense of that in just a sec. So the national market, it's still moving. The outcomes though for 2026 this year, you're going to have to go and earn the growth, right? It's not just, like I said, buy anything and it's going to grow significantly in value. So I've always said to the team for a long time leading into 2026 that this is going to be a year that separates the great buyers agents from the average and the shit ones out there. It's going to be the year that separates the great property investors from the shit ones, whether you're doing it yourself or using a BA. So let's get into the capital city performance. I always like to put them in an order of growth for the previous month because momentum matters and it tells us where they are on a particular property market cycle. Because whilst, yes, we have a national property market, every state, every capital city, sometimes every suburb within the capital city is slightly on a different time of the market cycle. So let's get into it now. We've got Darwin, which is annually up 18.9%. Median value in Darwin sitting at $576,000. We've got a smaller market here in Darwin. As we know, the population isn't massive. It's got a much higher volatility. But to be fair, it's got some very strong momentum and it's very affordable. So I know a lot of buyers agents that are buying there. That's not us. But there are also a lot of investors that have been chasing the yield in Darwin for most of 2025. And there's some definite growth there. Like I've always said, I'm not a fan of Darwin. I'm not going to be buying in Darwin anytime soon. Yes, there's going to be some investors that will get some good gains there, but it's not a long-term market, right? And for me, property is a long-term play. Yes, you can make these short-term gains and flip and get exit out of markets and all these sort of things. You've got to look at your costs of doing that. But Darwin is leading the charge as it relates to the capital cities. Perth, my good old friend, Perth up 16.7% annually. Median level sitting at $813,000, and Perth market is still strong. It's very clearly in the later stage of its market cycle. Buying average shit properties in Perth, not really going to get some massive gains like you would have if you did that maybe 2 years ago. You can still get some good things done. I'm buying in Perth and more so the sort of southern WA region very sparingly for the right investor, the right asset at the right price. But it's not like, a large part of our buying at the moment. Would I recommend the average investor buy in Perth right now? Not really, because there's some markets on the East Coast, which I'll tell you exactly what they are in just a second. But it's always good to just see, what are the numbers saying? After all, this is a numbers game. Next on the list, Adelaide up 13.1% annually. Median value in Adelaide, $783,000. Adelaide's got some good fundamentals there, without a doubt. It's a market where you've got to be pretty selective now about the type of asset that you buy. Am I buying in Adelaide? No. And would I recommend it? For the average investor with a budget of like, 6, 7, 800,000, I wouldn't really be recommending Adelaide right now. But I will recommend some suburbs in just a second. Brisbane, my good old friend, dear to my heart, up 8.6% annually. Median sitting just over $1 million in Brisbane. Brisbane market is extremely strong. It's just expensive now, which is insane, right? There was a time, I think it was like 2016, 17, 18. It was like, oh, don't buy in Brisbane. Brisbane's fucking shit, blah, blah, blah. Now look at Brisbane. Huh? Take that, haters. Brisbane's doing well. So would I recommend buying in Brisbane? Absolutely. 100%. Just being, selective, right? Like if you're buying in Brisbane, and you're talking about houses, you're clearly going to have a pretty decent budget of kind of well into the 800,000s. I'm trying and focusing on buying higher quality assets. There was a point in time when I was buying like shacks in Brisbane. They weren't shacks, but like a lot of people would think they're shacks, right? In my personal portfolio, which have doubled, tripled in value. I wouldn't be buying those types of assets now at the prices that they are, but I would be looking to buy higher quality houses in Brisbane, and even the unit market in Brisbane as well. I definitely would consider it if you've got a budget, a lower end budget. And again, I'll get to the areas in just a second. Sydney up 7.1% annually. 1.27 million is the median value in Sydney, which is absolutely crazy. Sydney's a market that I know very well. Obviously used to live there for some time. Would I buy in Sydney? I would on the lower end unit market. I would consider buying in Sydney if you kind of, you had some ties to it and you wanted to be there. Not that I ever recommend buying because you got ties to it, but I know some people do that. Not for me. Slightly negative movement in the month, right? It actually went backwards in the month of December, 0.1%, which is not really anything really, but interesting still to note. Again, obviously just at the median level, those numbers are coming from. Melbourne, annually up 4.8%. Not much to really report out of Melbourne, despite all of the buyers agents, including myself. I am buying in Melbourne. But despite all of that activity, it's still not really like digging in and moving. Obviously, just at the median level now, there are some amazing deals I'm seeing where we're seeing 30, 40, 50K growth in 3, 4, 5 months. But at the median level, it's kind of a little bit flat, right? Nothing's going on. And this is why, it's important to go through all this data, but don't always rely on it. Like it's not just if we're just going off data alone, you'd look at Melbourne and be like, mate, this is rubbish. Like, why would I buy there? It's not always the case, all right? So we've got to do a little bit more digging other than just looking at the headline numbers, which is so important to get right. Now, rounding out the list here, Hobart, Canberra, not much to really report here. Hobart, well past its boom phase. It's stable, but it's pretty quiet. Canberra, wouldn't really recommend doing anything in Canberra. So what this is really showing us is that momentum is getting pretty narrow with the type of market that you want to be in. Affordable markets are still moving. Higher price markets are kind of just, they're not coming back in value, but they're just maturing, right? They're stabilizing. Okay, well, I'm here now. I'm going to kind of stay here for a bit. Very, very interesting. Now, what's changed on the ground, right? Like I said, we're buying in multiple states, Queensland, Victoria, sometimes New South Wales, sometimes WA. What I'm seeing is that days on market are getting longer for some areas in Melbourne, some areas in Sydney, and also importantly, some of those regional pockets where we were once buying where properties were moving like flying off the shelf. I'm seeing the days on market start to stagnate there for some time. Like, so think places like the regional Queensland boom. That's probably the big sort of standout as to where stock is just staying on market. Like, you got vendors that saw the boom and now they're kind of like expecting these massive prices and they're not really moving for those price expectations. So the properties are sitting there for a little bit longer. The clauses of your offer, so your finance clause, your settlement terms, those are making a difference in getting deals done. To give you an example, I picked up a property in regional Victoria for $428,000 this week, a couple of days before filming this episode. Freestanding house, big block of land, property's in nice condition. It is a little bit older, obviously, for that price. But we got the deal done because we had a massive settlement. I think we settled, in May. Like, it's fucking a long settlement. For that particular vendor, it made sense, right? And that's how we're able to pick up that deal. So clauses are starting to matter. Price is obviously always going to be important, right? It's never not. But that being said, having clauses that fit the vendor and obviously your circumstances can see you get some good deals done out there. I'm seeing a lot of valuation risk increase for really poorly selected assets. So another example, we've had some word on the street, in places like regional Queensland where the market's been fucking hot, right? You've got people paying and offering massive prices which aren't really matching the valuation that's getting done through the buying process, right? And so people are getting caught out there. So it's definitely not a weak market, right? The market is still very strong, but the execution this year is going to be really important. I keep saying it. It's not just buy anything and it's going to grow massively in value. Don't get me wrong. Over the long term, property is a great growth asset, but that short term growth that we like to get and is often seen online, the 50, 100, 150K in the first sort of 6 to 18 months, you can still get that, but you've got to be really particular about the market that you're going into. I want to touch on borrowing capacity because this is basically a strategic asset for investors out there, right? Like, we were expecting rates, and I called it out maybe, I don't know, less than 6 months ago, that we were expecting rates to come back down based on the cash rate futures, but we haven't seen that, right? Inflation's been hanging around a bit longer than what really anyone was anticipating, and therefore rates have kind of stayed the same. Now this year, my expectation, and I'm not an economist or whatever, but like, I don't really see rates coming back down so dramatically like we once thought they were going to do. So that means the borrowing capacity for investors isn't really going to change too much if your income doesn't change with it. So every purchase that you do now is, as always, it's going to affect the next one massively. If you've got really shitty cash flow on a property, it is going to impact your future borrowing assessment more so than it really ever has. Now, am I saying to get a positive cash flow property? No, and I never will say that because they don't really exist in the traditional sense anymore. The equity releases that some investors are going to potentially be getting out, you've got to be careful because you might release the equity, you might not be able to go and buy again. So you want to make sure that you're thinking a few steps ahead with your broker and planning a few steps ahead to go, okay, if I release this equity now, can I actually go and buy another property after that? And if I can, what type of lender is it going to be with? Is it a second or third tier lender? What do the rates really look like? So before you go and do any of that, you can run some numbers and be like, okay, cool. If I'm going to pay 6-7+% with a first MAC or whatever it is, can I afford to do that? What type of asset do I need to make sure that actually works? So this is the strategic side of things, particularly on the lending front, is going to be really, really important. as some of you might have seen, lenders are starting to be a little bit more conservative now, particularly as it relates to trusts and things like that. Macquarie Bank being one of the first, big banks to really change their policy around trust lending. Now, you can still get it done, but it's probably going to be with a second and third tier lender, which ain't bad, but just means you got to factor in the fees and the higher rates and that sort of thing into the buying equation that you are looking at. So, it's a scenario where we've just got to think in sequences. Think in, okay, I do this move now. How does that affect the moves 2, 3, 4 moves later, type of thing. I just touched on it, but cash flow, holding costs, and the tax reality of our portfolios is a big risk. Like for me personally, like looking at cash flow, it's become a bigger priority for me now, having 10 properties in the game, than it was, maybe 2 years ago. Definitely than 2 years ago. So I'm making sure that all the properties I've got, the rents are at market rent, or, when they expire, they're going to market rent. I'm making sure that my tenants are happy. They've got everything that they need to be happy and stay. So I minimize any vacancy periods that potentially can arise. This tax deduction bullshit is not a strategy, right? I see so much of this online, and I've so many people, professionals in the industry, like talk about tax deductions as if it's a property buying strategy, or it's not, right? I always say this: you never buy anything to lose money on it to get some of it back on tax. That logic doesn't make sense to me, right? Unless maybe you've got, a massive tax bill, massive income, all that sort of thing. But for the average person like you and I out there, that shit does just not make any sense, okay? Depreciation improves an outcome, right? But it doesn't fix a shit asset, okay? So if you're, and I know there's a few people out there that want to buy a new build so they can get the depreciation, sure, that might improve the cash flow outcome slightly. But if you've got a really shit asset that's in a shit area that's not growing in value, that ain't going to fix that, right? So don't ever overlook the fundamentals of why you're investing in property. It's generally to grow your wealth, then pivot into some cash flow later down the line. I just want to, I feel like I'm a bit more aggressive on this one, but it's important. And like I said, I always say, like, I make these podcasts and put them together because when I was sort of 10, 15 years ago looking for content like this, it didn't really exist. It was always like some buyer's agent trying to spruik their strategy, their thing. I don't care. You do business with us. Awesome. We can do some great things. If not, it's also fine. You get some great value out of it, right? So if I come across a bit passionate about it, it's because I am passionate about property and the market and all the dispelling all of the bullshit out there, because there's so much of it, right? Now, let's talk a little bit about liquidity. Okay, so this is a big silent risk that I think we may need to shine a bit more of a light on, particularly this year. So most failures don't come from falling property prices. They come from insufficient buffers. Okay, so what I mean is, like, most people that fail in property don't fail because the property price falls. They rarely fall unless you bought in, like, I mean, even Broken Hill would have gone up in value, if not very smallly, right? Minimally. They come from not being able to hold the asset. They come from that squeeze and that pressure that we're all trying to avoid. And then they go, oh shit, I need to offload this thing now, right? And sometimes you might need to offload at a bit of a loss in sort of special circumstances. But it's just from not having a sufficient buffer there to buffer the stress, essentially, right? That's where a lot of the failure comes from. So having good liquidity in property is going to allow you as the investor to absorb interest rate changes. Now, I don't expect the rates to rise as dramatically as they have in previous years, but I'm not expecting them to fall. So if you've got a negative cash flow asset now that's burning a hole in your pocket, it might not get too much easier, is the point. Having good liquidity allows you to handle any maintenance things that come up, because, you know, just using my experience with the 10 properties that I've got, touch wood, they've been mostly awesome, but there is some times where I had late last year, a $40,000 bathroom issue in one of my properties, right? Insurance ain't going to cover all. Didn't cover all of that, and it's just like shit. Okay, I gotta come up with this, and that really burnt me for a period of time, because like that's a lot of cash outlay to fix an issue. Property's not getting property couldn't. A tenant had to move out because it wasn't like so many things happen, right? And it can happen at a drop of a hat. Like you just don't know. You get a call from your PM, and it's a shit outcome. So that's what I'm saying. Like, have the buffer there so that when unexpected things come up, you can then sort of make some maneuvers and get things done. So, however that buffer really looks for you. Some people like to have it in cash. Some people like to have a spare credit card that they don't use in case they fucking need to. There's no right or wrong. Some people like to have a redraw on their home loan. Whatever it is, make sure it works for you, and you've got something there that if something goes down, you've got that to just, all right, cool, emergency situation. Let me go sort this out. All right. So where do I see the growth occurring in 2026? Now, I've debated with myself and the team on this for a while. I've been thinking about this since late last year. And like I said, this is going to be the year that separates the good BAs from the shit ones. And to be honest, as a buyer's agent, I'm nervous about that. Like I'm nervous about, which markets we go into, which markets we don't, what's the reason why, what due diligence do we run on the market that we're looking to get into, all those sorts of things. And I guess ultimately because I'm passionate about it and I want to get the best result. So I do put that pressure on myself, but it doesn't take away from the fact it's going to be a very different year regardless of how anyone feels about it. So, in my opinion, the growth is going to be concentrated on the lower and lower to mid price brackets in a lot of the capital cities, particularly Brisbane, particularly Melbourne, parts of Sydney, and obviously the other capitals to a degree as well. And again, I'll get into the specific locations in just a sec. The growth is going to occur in affordable freestanding houses. Okay. And that will be in some regional locations. Absolutely. Selected regional locations with strong employment, good sort of infrastructure connections, not too remote, essentially, good population centers, that type of thing. The unit market, I do see doing well as well, but they got to have some scarcity to them. So like I always say, we avoid the brand new apartment builds. We avoid the high rise apartment builds. So sort of think the 2, 4, 6, 8 sort of unit blocks that might be made out of brick, maybe 2, 3 stories high max, that sort of thing. They're obviously aged, so which is a great thing because you often find a lot of the maintenance bullshit is kind of ironed out. So you don't have these massive strata bills and all that sort of thing. So scarce, well-located units I absolutely see doing really well in 2026. And like I said, the regional centers with genuine diverse employment options, good, strong population centers I see doing really well here as well. Just want to talk houses versus units. There was a point in time when I was starting my investment journey, it was a big thing. It was like, houses are going to always outperform units. And it's like, don't buy a unit, blah, 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 all this kind of crap. Which I think that narrative has changed largely just because of affordability, right? Now, fundamentally, maybe it's the old school tradition in me, but yeah, I would, if you can afford a house, probably would go down that route. But if you can't, or you may be on the fence, don't overlook units. But the selection of the unit is critical. So what works is kind of like what I just said. So the established low-rise units, love that sort of stuff. If I could, in fact, I'm personally going to be looking at buying some of those types of assets in 2026 if I can get my lending sorted, which I will. I'll get it done. We always make something work. So established low-rise stuff, you've got to have very low strata. So you want to assess that before you even put down an offer, really. Make sure that obviously the insurance is reasonable too. Areas where you got to have a stronger owner-occupied demand than renters. So essentially you just want to have more owner occupiers than renters in the area that you're looking at. The red flags, like I always say, the high rise towers, the right where they might have a change in strata, insurance costs, this year. You can sort of see if there's any works planned. That's a red flag for me. It's like, hey, we've got to change the facade of the building, or there's a leak or whatever. That you see that in the strata report. That's a big no-no. And there's going to be some lenders that are going to be very sensitive to that type of asset as well. So you want to be checking with your broker about the postcode, the type of asset that you're going to buy, so that you don't have any issues, anymore. So this is really not about houses versus units anymore. It's really resilient assets versus fragile ones. Okay, because you can have some really fragile freestanding houses in some really shit markets, but really strong units in some great markets. So in terms of the approach for this year, prioritizing resilience over speed. Now, no, because a lot of people are like, shit, I'm missing out, FOMO, blah, blah, blah. But like, you've got to have a resilient portfolio to see through this year and potentially next and beyond, to see that through to the other side. Negotiate hard on price. Like, don't just see the asking price and put an offer in at that. You've got to do a bit of work around, okay, what are actual properties selling for? What's the speed of the market? How long has the property been sitting on the market? What's the condition? You've got to do a full assessment so that you understand the value. And I've done a podcast in the recent weeks on how to work that out. So go and check that out if you want to work out how to make sure you're not overpaying for a property. Stress test your assumptions. So before you put down an offer, get all the information you need. If you're buying a unit, what is the strata cost? Is there any expected increases through the year? What is the insurance on the property? What is the property manager in the area that you're going to look at? What are the council rates? What are the utilities? All that sort of stuff. Stress test it, and like, don't be conservative. When you're running those numbers, like add a round it up to the nearest 100 or whatever it is, just to build a bit of buffer in there so that, you're stress testing it properly is really important. Try and get yourself a larger buffer. So for, like I said before, any maintenance stuff that comes up, maybe it is a mix of cash and a credit card, or maybe it's a mix of cash and a redraw facility, whatever it is. And that's not financial advice in any way, but have something there so that you can kind of, I don't know, for me, I want to sleep better at night. So I know if like shit hits the fan tomorrow, I've got an emergency way out of it. It's not going to be about volume this year, like how many assets you can get, right? I want to get to 10 properties or 20 or whatever it is. It's just about better assets at the end of the day. And regardless of houses, units, whatever market it is, Sydney, Melbourne, Brisbane, whatever state, doesn't matter. It's just got to be a quality asset that works for you. So you definitely don't want to sit on the sidelines and, be in fear about the property market bubble bursting. There ain't no bubble. This is just the way that the system is designed. I've said this so many times before. You want to get in, you just got to be selective about what it is that you do. So let's get into where you can focus based on your budgets. Now, let me bring this up on the trusty iPad. Now, we do have, firstly, budgets under 600,000. Let me just have some water. Let me get into it. All right. So first on this list is the Southern Logan Corridor. Yes, that's right. I'm saying it. The Southern Logan Corridor for under 600K. We're obviously not buying any houses for that price, but there are some good units in some good locations that you can still pick up. Now, there's not too many available at that price point. It is thinning out quite a lot, but it is an area that is going to benefit broadly from economic activity from the Gold Coast and from Brisbane. You've got to be selective, obviously, about that area with flood zone exposure. You want to make sure you're in a quality street with a quality asset. Okay, really important to get right. There's not too many available, to be completely fair, but there are still some, and I still think it is a great market to get into for budgets in that under 600K range. Now, second on my list, Geelong. Okay. Now, Geelong is a beneficiary of that Melbourne spillover, okay? It's got pretty diverse employment, very strong rental demand, and in this market, at that price point, I think townhouses and units are probably going to offer a better quality asset over a freestanding house. You can still get freestanding houses in Geelong, but they're going to be in the undesirable areas. Not that that's a bad thing, but again, we're focusing on quality assets this year and quality locations. Okay, so in Geelong, between the sort of 3 to 600K range, you can get yourself a nice townhouse, a nice unit with a pretty decent yield to go with that as well. And third on my list is regional Victoria for budgets under 600K. Now, regional Victoria, you can definitely get some houses in some of these locations, which would be Ballarat, Bendigo, and I'll get to those two in a second because I know I shit on those two suburbs not so long ago. But Ballarat, Bendigo, Shepparton, Wodonga, Traralgon, and a few others that we're buying for our investors, which I don't spruik locations, guys. So I'm not going to give that away entirely, but you've got some there to sink your teeth into. Now, let me talk about Ballarat, Bendigo. It's a funny, fragile situation, right? I feel like markets, they're not. It's not moving like, if you think about a car, right? Like you're getting onto the freeway and you're going from 60 to 100 Ks, and you'll probably, depending on how you drive, you'll smoothly get there. You're not going to be accelerating, braking. So putting that into how the growth and the momentum in these Ballarat Bendigo markets, it's not that smooth acceleration onto the freeway. It's like acceleration, brake, kind of turn a little bit, handbrake, like accelerate. So it's a very tricky market to get into. I've obviously bought for investors there, which has got some great outcomes. You just want to be careful that you're not overpaying and you're getting yourself a quality asset. That's the only warnings I'll give you about those two markets, because there's a shit ton of buyers agents buying there, and it's very easy to get caught up into a bidding war, even unbeknownst to you, because of how the agents sort of maneuver the situation and things like that. So there's some amazing deals there. Just be careful and validate the price before you buy. That's all I'm saying. All right, so those are the budgets for under 600,000. Now for the budgets over 600,000, you're not going to be surprised with this. Melbourne is the first on my list. Okay, for anything between sort of 6 and 800K, you want to spend in that sort of range. You want to focus on that middle ring. So here's a couple of areas in Melbourne that I really like. Werribee, which is one of the first times I'm mentioning this on one of my podcasts. Love Werribee. Just in case you haven't seen my stuff before, don't buy the brand new stuff in that Western Corridor. Avoid the brand new stuff in the brand new areas. Go where the existing properties are in the high owner-occupied demand areas, okay? Stick with that. At these sort of price points, under $700,000 in that Western Corridor, love it. Beautiful, okay? On the eastern side, Frankston, Dandenong, been buying there for a long time. Love that area. Very strong owner-occupied demand in those markets. Focus on houses where possible. If you've got a budget like this, over 600K, there's a good chance you can get yourself a freestanding house. As I always say, focus on the established areas rather than the new estates and the investor-heavy, unit market, that type of thing. Okay, so love Melbourne in that price range. Be selective about what you're buying. And second on my list for budgets over $600,000, here's my good old friend Brisbane. All right, Brisbane. I love it for so many reasons. One of the biggest things is there's so many people moving here to the southeast Queensland sector, from Sunny Coast down to the Gold Coast. It's absolutely pumping. There's thousands of people moving here month on month, and it is reflective very much in the property market. I'm going to open homes here every single weekend, and there's a lot going on. So budgets over 600K, particularly Brisbane, you're probably going to have to squeeze into the north of the 800s to get into a high quality house, freestanding house in that market. Like I said, you can definitely get yourself a very good townhouse unit with budgets over 600K, excuse me. So where would you want to focus on? Kind of anywhere in Brisbane, really, but you focus on the established suburbs. As I always say, broken record, right? Like, don't do the brand new shit, brand new areas. Avoid being anywhere in them. You can maybe be near them if it's an established zone, but don't go the new stuff. Just established areas, wherever it makes sense for you budget-wise. Ipswich, you can probably get something. In fact, you can definitely get something under 800. That's good. That's good. On the northern side, you're not really getting anything less than 850 anymore. That's good quality. But anywhere that is affordable for you, nice street, nice asset. Don't do the new stuff. Love Brisbane for that reason. So that is the 2026 January property market update. Hope you got some value out of that. If you made it this far in the video, I appreciate you. Leave a comment, thumbs up. Consider subscribing, as I always say. Let me know what your take is on the 2026 property market. It's going to be an interesting year, guys. Like, I'm eagerly anticipating and eager to see how it plays out. Day to day, week to week, month to month. I'll be bringing you property market update every single month as we go through the year as normal. If you are looking to get into the market in 2026 and you're looking to get some help with that, you're not sure where to buy, what to buy, how to buy, you don't have the confidence, or you don't have the time, that's where our service can add some value. If you're on YouTube, there is a link in the description where you can book a call with us. Doesn't cost you anything except maybe 5-10 minutes of your time, and it will explain what it is that we can do. If we can help you, we'll show you how, and then you can decide on what next steps that you want to take. So that is all we have time for today's episode. As always, I appreciate you. Thank you for watching. I'm Nick V. Until next time, catch you soon.